Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is Thursday, September 8th, and it's about 4:30 on the West Coast. A little bit later than I normally like to do these, but it was one of those days, which I'm sure a lot of you guys can relate to. So since we last spoke, the market's been kind of up and down rates. I think last Thursday, the average conventional was about 6.23. We went down to 6.01, went back up to 6.25. And right now, I think it's about 6.10 or so, depending on how it comes out in the morning. It's a little bit late in the day, so a little bit later. Like I said, that we've got to keep a close eye on that. Rates are what they are right now. We expect them to start to come down as inflation gets under control. A lot of the experts you'll hear talk, end of fourth quarter this year into the first quarter next year. We should see that inflation number start to come down, and with that, rates should come down. And we just got to hope that that doesn't negatively affect the rest of the economy too much. But I wanted to concentrate today on something a little more positive, given all this negative rate talk, and show you guys something that has to do with basically the health of the loan economy right now. So something I've touched upon before is that back in the housing crisis in 2008 or so, back then the loan industry was very lax with its money and gave a lot of bad loans out to people with poor credit, and not very good chance of repaying actually. And when you look at it, so now, as you can see, this is coming out from the Mortgage Bankers Association, Moody Analytics, and this is the percentage of mortgage loans delinquent and in foreclosure. So blue is delinquent rate, 30 days and over, when someone's late on their payment, and then green is in foreclosure rate. So as you can see, going back to 1974, blue usually tends to stay above that, about 4% mark, and it kind of ebbs and flows. And in the financial crisis back in, 08, 9, through that time, you could see that those definitely went up quite a bit. In the pandemic, late payments went up, which makes sense too. But now, as you can see, that's fallen beneath that 4% line. And then the in foreclosure rate is really where it's just minuscule. It's almost at a lowest, basically historical level lows. So as you can see, going back to 74, it's always a little bit thicker line as you go across, and obviously goes up and down at different times. And in the financial crisis, it was a lot higher. A little uptick in the pandemic, and then it's come down pretty quickly. So that just, guys, kind of goes to show you as the differences between 2007, 2008, 9, and maybe like what we're headed into the next year or two. Correction, not a crash. So, and part of that, besides, part of that being is that the borrowers that we have now, the people that own these homes, are much better qualified. And so there's a better chance of, them being able to keep the home and make their payments than there was in the past. So like I said, I thought that was important to show, just to keep people away from the skies falling, is that, still, as far as our industry goes, people are paying on time. They're not getting foreclosed upon. It's everything's good so far. And that also plays into, as far as people having more equity. And that plus this is one reason why people are going to be in a lot better shape than they were back, when this spiked with this big blue and this big green back in, like I said, 08, 09, 10, that kind of range. And get out of here. So the other thing I wanted to talk to, I'm going to make this a quick video for you guys today. The other thing I want to talk to you about is something, we're seeing a lot in the industry. And I'm sure across the country, different places, same thing. We're seeing a lot more seller credits offered by sellers, and you'll hear a lot of seller credit to buy the rate down. So I just want to talk about that real quick, because I had one recently that kind of touched upon that. And it all depends. You only want to buy down the rate enough that it makes sense. And it's just like refinances, where we kind of look at you should be able to recoup the money you spent within 2-3 years, maybe max. And then, to be honest, in this rate environment where we expect rates to fall in the next year or two, you really should probably aim for a smaller window than that, because if you spend a bunch of money to buy the rate down and then you refi before you recoup that money you spent to buy the rate down, then you just gave that money away. That you're not getting that money back. It was basically just more closing costs. So you kind of have to make sense. So if someone we're going to put $10,000 towards in buying the rate down, and that saves you $100, that's 100 months. It's going to take you 8.5 years to recoup that. It doesn't really make a lot of sense. So you're seeing a lot of that out there right now, and you're also seeing some people using that as kind of a tactic to kind of bring people in. It's like, oh, look, we'll buy down all this way, and then if you look at the math, it just doesn't make sense. And it's always about the math. You're always trying, just like with refis, you're always just trying to make it that the money paid is going to be recouped in a short enough period of time that it makes sense. And so, especially like I said, in this rate environment with things hopefully coming down here shortly in the next year or two, you really shouldn't be spending a ton of money that's going to take 5 years to recoup when at that point you're just basically giving the bank money. And I'm sure the banks would love for you to do that, but as borrowers, for your clients, just kind of be on the lookout that it's not always. You shouldn't always throw that whole seller credit towards buying down the rate, because there's a certain point of you're not getting a good return on it. Some of that should be going towards buying the rate, and that definitely helps people right now in getting their rate under and getting the payment where they want it, and make this whole rate environment a little bit better for folks. But some of it should go towards that. The rest could go towards other closing costs, can cover all the other stuff that they have to pay for in the loan process, which we all know about. So that's something I want to talk about. It's something like I said, you're seeing a lot more of that, and it's a great thing to do. Is just make sure that it's being used wisely and in your client's best interest and your best interest if you're looking right now. So like I said, that's all I really had for you guys today. If anybody has any questions about anything going on or wants to talk about a scenario, please do not hesitate to reach out. Hope you guys are having a great day, and I'll talk to you soon. Thanks a lot.